If you're thinking about using rent to own as your best option to purchase your home, I've got some info for you in this video that you need to watch before you set yourself up for significant failure. For those who don't know me, my name is Mike West, and I'm a licensed real estate agent here in Southeast Michigan. And I love to help educate on the entire home buying and selling experience. Keep in mind, much of what I cover in my videos are most often geared towards what I see in my market area, and some things may change based on your location if you're outside of Michigan. So, a question that I probably get asked almost more than anything else is, do you have any rent-to-own properties? The truth is, rent-to-own is mostly a myth, and here's why. A large majority of the people unfortunately heard the term from someone else without really knowing anything about the transaction or how it may work. And at the end of the day, they have collectively decided that rent-to-own means I'm going to rent the home, and over time my rent is going to pay for the property, and then I'll own it. Now, something like this does exist in a matter of two separate fashions, but not exactly the way most people think. These two popular methods of buying real estate are known as land contracts and lease options. We'll explore their benefits, drawbacks, and how they differ from one another. If you are considering one of these options for purchasing your property, this video will help you make an informed decision and hopefully save you from terrible outcomes so many others have found themselves in. First up, let's talk about the land contract, also known as a contract for deed. I feel this is the most common method and the closest thing to an actual rent to own. A land contract is an agreement between a buyer purchasing the home from a seller using what we call seller financing instead of a mortgage or other traditional type of loan. Essentially, the seller becomes the bank and the buyer makes installment payments directly to the seller. And the seller retains the title for the property until the contract is usually paid off in full. Essentially what happens in these scenarios is this. Buyer and seller agree upon a purchase price. They'll agree upon a down payment amount for the purchase. They'll then agree on an interest rate to be applied for the purchase. Then they'll agree on an installment plan, whether this is monthly or quarterly or whatever they have planned works. There will also be a term length that is predetermined for the amount of time the buyer will be making these payments to that seller. Sometimes this can be as little as 1 year, or it can be up to 30 years or more. However, most of the time, I find that many sellers using this type of financing will often do about 5 years plus or minus a couple years. At the end of the term, a balloon payment is usually required to fulfill the remaining balance of the purchase, plus any interest accrued. Here's one of the biggest traps I've seen most buyers get caught in when doing this. They often don't realize that there even is a balloon payment or what that is. They never prepare for it. A balloon payment is a large final payment due at the end of a loan term. It's called a balloon because it's typically much larger than the preceding periodic payments, which are generally smaller. It needs to be paid in a single lump sum. So, for a simple hypothetical example here, let's say you are looking to buy a home via land contract for $150,000, set to a term length of 5 years, with a monthly payment of $1,500 per month, where the entirety is going towards the principal balance, meaning there's no interest. Let's also say that you paid $10,000 as a down payment. That means that over the course of the 5 years that you've owned this home, you've paid a total of $100,000. Obviously, that doesn't pay for the whole balance of $150K that we agreed upon in the purchase. You still owe another $50K on that home, but now it's due in that single lump sum, that balloon payment. The amount of people I see who are usually financially able to come up with such a large sum out of pocket are very few. If the buyer can meet the qualifications, they can take out a loan from an actual bank to pay for this off, whether it's a new mortgage or even a personal loan. But the problem I've seen a lot is that many buyers often do not prepare their personal financial or credit status over this term, and they can't meet those requirements. Or they simply wait too long to apply. They wait until that balloon comes due and then apply, which that loan process, as you may know from some of my other videos, can take 30 to 45 days. So then what happens? The seller forecloses on them. They get booted from the house and they lose all of their money that they spent over the course of that whole 5 years. The seller, they get to keep the property just as a bank would if you defaulted on a mortgage loan, and then they get the chance to go ahead and resell it again. I've personally seen this happen way too many times. I don't want it to happen to you. So my advice is to seek some professional assistance to help guide you through that process, but make sure you have a full awareness of the terms and conditions and plan for it appropriately. Everything should be in writing, and It should be properly recorded with a title agency to ensure that you have a credible lien against that home and the right to control that asset. Should you decide you actually want to sell or refinance the home in the future, you need to have that level of control. So let's talk about some of the benefits of a land contract. Number one, it's traditionally easier financing. If you have had trouble getting a traditional mortgage, a land contract can be a good alternative because sellers are often more flexible than banks when it comes to actually qualifying a buyer for the financing. Number two, there's some down payment flexibility. Because the agreement is made between the buyer and the seller, down payments may be lower compared to a traditional loan. This can be especially advantageous if you're starting out or have a limited savings. Number three, there's potential for negotiations directly with the seller. Terms such as the interest rate, the payment schedule, these can be negotiated directly with the seller to find a way that works for the both of you. But make sure to do your due diligence before entering into any of these negotiations. Number four, it's a quicker transaction. Since you're dealing directly with the seller, the process can be a lot faster than going through a bank or a lender because you're not waiting on underwriting, pre-approvals, all that fun stuff. But now for some of the drawbacks of the land contract. Number one, no immediate ownership. You don't technically own the property until the final payment is made. This means that seller holds the title and can potentially complicate matters if disputes arise, which is why I suggest that you should make sure this is all properly recorded and the seller can't try to sell it out from under you, which I've seen happen. And it'll also give you the opportunity to control that asset, as I mentioned earlier. Number two, higher interest rates. Often the interest rates on land contracts are higher than that of a traditional mortgage. This is simply because the seller may be taking on serious personal risk, and you may also just simply be a more risky loan applicant. Number three, since the down payment is determined between the buyer and seller, you also run the possibility of actually paying a higher down payment than a traditional loan. There's no flat fee or predetermined factor except what's negotiated between you and that seller. Number four, the risk of default. If you default on payments or fail to make that final balloon payment, you could lose the property and any money you've already paid, as the seller may have the right to terminate the contract or foreclose on you. Number five, limited legal protections. Depending on the state, there may be fewer legal protections compared to that of conventional mortgage agreements. Make sure to check with your state legislature and discuss with your professionals about how to properly do this. Land contracts like this are the most common types of rent-to-own situations that I see. However, at no point are you a renter in this scenario. You are a homeowner right from the start, paying a mortgage to the seller as if they were your bank. But now let's move on to lease options. A lease option is a rental agreement that gives you the right to purchase the property by or before the end of the lease term to a previously agreed upon price that was determined at the start of the lease. It's essentially a two-part deal. First, you lease the property, and second, you have the option to buy it. Now in this scenario, unlike the land contract, you are indeed a renter, paying a monthly rent to that landlord or property owner. But if you decide you actually want to buy that home, you have a locked-in opportunity before the owner could sell it out to anybody else at an already agreed upon price. Though you would likely need to seek out a more traditional financing option to do so, or make arrangements for the future for a land contract or seller financing. The benefits of a lease option. Number one, you get the opportunity to test the property. You actually live in the property before committing to the purchase, which allows you to test the home in the neighborhood and make sure that it's a good fit for you. Number two, you've locked in the purchase price. You have the option to lock in a purchase price at the beginning of the lease term, which can be beneficial if the property values increase over that period. Which leads me to number three, building equity. Not always, but sometimes it can be worked into the arrangement where a portion of your rent payments might be credited towards the purchase price, helping you build equity over time, and with increased values by the time you choose to execute that lease option, you may be coming into having a property that is worth more than you bought it for. Number four, flexible terms. Lease options can offer flexibility in terms of the length of the lease and the purchase price, which can be tailored to your needs. Number five, if you decide that you do not want to purchase the home, you can't be forced into doing so. Now for some of the drawbacks of a lease option. Number one, oftentimes there's an upfront option fee. Not always a requirement, but it is common that you may need to pay an upfront option fee, which can be substantial, similar to that of a down payment. Number 2, you may also be charged a rent premium. The rent you could be paying for this property may be higher than the market rates, as it may actually go towards some of that purchase price we talked about, or it's simply seen as a premium just to hold that option. Number 3, the purchase obligation. Unlike a land contract, a lease option does not obligate you to buy the property, as previously mentioned. However, if you decide not to, the option fee that you paid earlier is usually non-refundable. Number 4, there's always market risk. If the property values actually decline, you might end up paying more for the property than its market value. And if you choose to exercise this option and use traditional financing, this may pose problems with getting a low appraisal, possibly preventing you from even securing the loan and buying the home. So, how do land contracts and lease options differ? Number 1, ownership. With a land contract, you don't get the title until the contract is complete, but you can control that asset. With a lease option, you only have the option to buy that property after leasing it and have no control over that asset. Number 2, the payment structure. Land contracts involve monthly payments directly to the seller, with the property eventually transferring to you. Lease options involve rental payments, where the monthly fee may not be going towards the purchase price. Number 3, your obligations. Land contracts require full purchase once agreed upon, while the lease option gives you the flexibility to decide whether or not you want to purchase that home after that lease term is up. Number 4, the risk factors. Land contracts carry the risk of losing the property if you default, while lease options have the risk of losing the option fee if you choose not to buy or wait too long. Both land contracts and lease options have their unique advantages and potential pitfalls. The right choice depends on your financial situation, your long-term goals, and your personal preferences. Always consult with a real estate professional to understand what's best for your specific needs. If you found this video helpful, don't forget to like and subscribe for more real estate insights. Thank you for watching, and I'm going to see you next time.